Navigating the waves. Harnessing stop-loss orders to safeguard investment portfolios. In the unpredictable seas of the financial markets, investors seek tools that act as life vests, providing a safety net amidst the turbulence. One such indispensable tool is the stop-loss order, a risk management strategy that empowers investors to mitigate potential losses and safeguard their portfolios. Understanding the mechanics and strategic implementation of stop-loss orders is pivotal for investors seeking to navigate the waves of market volatility with prudence and foresight. The essence of stop-loss orders. A stop-loss order is a predefined instruction given to a broker to sell a security once it reaches a specified price level. This mechanism allows investors to set a threshold for acceptable losses, automatically triggering the sale of the asset if the market price falls to or below that predetermined level. Stop-loss orders act as a proactive risk management tool, helping investors sidestep the emotional pitfalls of decision-making during periods of market turmoil. Consider a scenario where an investor purchases shares of company X at $50 per share. Wary of potential downturns, the investor sets a stop-loss order at $45. If the stock price plummets to $45 or below, the stop-loss order is activated, automatically selling the shares and limiting the investor's loss to the predefined threshold. Risk mitigation and capital preservation. The primary objective of implementing stop-loss orders is to manage risk effectively and preserve capital. By establishing clear exit points based on risk tolerance and market analysis, investors shield themselves from the adverse impact of unforeseen market downturns. Stop-loss orders act as a safety valve, preventing small losses from snowballing into significant financial setbacks. For instance, consider an investor who purchases shares of a technology company anticipating upward momentum. However, unforeseen market events, such as a global economic downturn or adverse regulatory developments, lead to a rapid decline in the stock's value. Without a stop-loss order in place, the investor may endure substantial losses. Conversely, with a well-calibrated stop-loss order, the investor limits the downside risk, freeing up capital for alternative investment opportunities. Volatility management and emotional discipline. The financial markets are inherently volatile, subject to fluctuations driven by economic indicators, geopolitical events, and market sentiment. Investors navigating this volatility can leverage stop-loss orders as a proactive tool to manage risk in real time. By setting stop-loss levels based on technical analysis, support levels, or percentage declines, investors establish a structured approach to respond to market dynamics without succumbing to emotional decision-making. Consider a scenario where a stock experiences a sudden and unexpected drop in value due to an unforeseen event, such as a negative earnings report or a geopolitical crisis. Without a stop-loss order, an investor may hesitate, hoping for a rebound, only to witness further erosion of their investment. In contrast, a strategically placed stop-loss order ensures a disciplined exit, preventing emotional responses and preserving mental capital during periods of market stress. Strategic implementation and position sizing. Effectively harnessing stop-loss orders involves a strategic approach to their implementation. Investors must carefully consider factors such as the investment horizon, risk tolerance, and the specific dynamics of the asset in question. Additionally, position sizing plays a crucial role in optimizing the impact of stop-loss orders. For instance, an investor with a higher risk tolerance may set a wider stop-loss threshold to allow for natural market fluctuations, while a more conservative investor might opt for a narrower stop-loss level to minimize potential losses. Furthermore, adjusting position sizes based on the overall portfolio's risk exposure ensures that stop-loss orders align with the investor's broader risk management strategy. Market conditions and tailoring stop-loss strategies. The efficacy of stop-loss orders is contingent upon their adaptation to prevailing market conditions. Different phases of the market cycle, such as bull markets, bear markets, or periods of consolidation, necessitate nuanced approaches to stop-loss strategies. In a bullish market, investors may employ trailing stop-loss orders, allowing for flexibility in capturing upward trends while protecting gains. Conversely, during a bearish market, setting tighter stop-loss levels becomes imperative to shield against rapid downturns. Tailoring stop-loss strategies to accommodate the prevailing market environment ensures that risk management remains agile and responsive to changing dynamics. Limitations and considerations. While stop-loss orders offer valuable risk mitigation benefits, they are not without limitations. In highly volatile markets, the execution of stop-loss orders may occur at prices significantly lower than the specified trigger due to rapid price movements. This phenomenon, known as slippage, underscores the importance of continuous monitoring and adjustment of stop-loss levels. Additionally, investors must exercise prudence in setting stop-loss levels, avoiding overly tight thresholds that may trigger premature exits during minor market fluctuations. A balance must be struck between protecting against significant losses and allowing for the natural ebb and flow of market movements. Conclusion. In the labyrinth of financial markets, where uncertainty is the only constant, stop-loss orders emerge as a beacon of risk management. Investors, armed with the strategic implementation of stop-loss orders, gain the ability to navigate market turbulence with resilience and discipline. As a proactive tool for preserving capital, managing volatility, and instilling emotional discipline, stop-loss orders empower investors to weather the storms of market dynamics. Fostering a resilient and adaptive approach to wealth creation in the ever-evolving landscape of investments.